Hi, welcome back to our YouTube channels. This episode, we are going to cover about option trading 101. So this, we are going to focus in terms of the introduction because these products compared to your futures products, it is a bit difficult. We are going to focus in terms of the basic understanding about option trading because this option trading itself can be very difficult even by the initial products understanding itself. So either you can understand or else you'll find that it's very complicated. So this particular topic, we will assume that you have a background in futures trading. If you never traded in futures, but at least you must have some background in futures trading itself, the knowledge itself. Later, I'm going to do a lot of comparison between futures and option. So from there, you will understand better. Second thing, for this particular topic, initially when I prepare, the slides is actually 60 over pages. So I really try my best to cut it to 1/3 of it only because we only have 15 minutes to conduct this particular session. But I will try my best to cover within the 15 minutes itself. If not, then just bear with me. So let's start with our topic, option trading 101. You need to understand option trading because option trading is part of derivative. If you understand there are four main instruments under derivative. Still remember you have your option, you have your futures contract, you have your swap contract, you have your forward contract. So option is one of the derivative products or what we call as derivative instruments. So we need to understand because combining in certain circumstances, you are going to see that option, if you combine with futures, the outcome will be even better. But before that, we need to understand the basic concept about option itself. Now, before we start, as usual, we need to do a disclaimer. Our topic for today is only meant for education purposes. There's no buy or sell call. Now, what is exactly option? We can apply what is exactly a futures in option perspective as well. So we are going to start with the definition, then we are going to start with those terminologies, meaning that those commonly being used terms or words in our industry or in option industry. Then the products available in Malaysia, what are the option products that is available for you or are available for you to trade? The underlying market, similarly, we need to know who is their parents in terms of this option. And the last one will be contract specification. But as I mentioned to you, I assume that you have foundation in futures. So this contract specification is just a glance through. We need to focus some things that is very different from your futures itself. Now, let's start with the definition of option. Now, option is like your futures. So this is also a contract. It's like your insurance. When we go into or when we buy an insurance, we are actually going into a contract or an agreement. So option is like futures is the contract between a buyer and a seller. Similarly to your futures contract, same. But what makes option and futures, the main difference is the upcoming part. Now, when it comes to option, we have two key things that you need to understand that makes option and futures a lot of different is these two keywords. One is rights, another one is obligation. Just in case, because these are the terms that we are using in the industry, I try to use a layman terms for you to really understand. Now, futures, we do not separate into this. But option, can see option itself, another words you can use is like your choice. If you do not want to use these terminologies, option by the English term itself is like your choice, your option. You have a choice to choose. So mainly from this option, meaning that we, either a buyer, if we are a buyer, we have the rights or we have the obligation. So option have these two, meaning if you have a rights, meaning I have the choice to go into the contract or not, or to exercise the contract or not. But it is not obligated for me to do that. But if you are a seller, you are being obligated to exercise if your buyer want to exercise it. Can you see the difference? One is you have a choice. The other one is It is a must for you to do that. You have no choice, you have no option. That's why these two keywords will make a great difference between futures and also option. Let me show you who has the rights, who has the obligation. Now, these particular tables summarize everything. Can you see here we have in terms of option, if you are a buyer, we can say that as holder. Commonly being used is holder and writer, but I put the slash is for you to easily understand. Holder or buyer or long. But I highlight this part so you can see that it's buy or sell. You are a buyer or a seller. Now, if you are a buyer, you have a rights but not obligation. Can you see? You have a rights but not obligation. Meaning whether eventually you're going to exercise and go into that agreement, you have a choice. If the market against you, you can choose not to exercise it. You're not obligated. But if you are a seller of an option, can you see writer, seller or short? I highlighted sell here, easy for you to understand. If you are a writer, if the buyer decided to exercise, you must fulfill it. You have no choice anymore. You have no option. You must fulfill it. Can you see that? So this is the difference between buyer and seller. Buyer, you have the rights. Since buyer have the rights, seller cannot be having the rights. Then who is going to fulfill the contract? So buyer have the rights, seller has the obligation. Now this is the first part that you need to understand. Because later, you're going to see that I'm going to combine with the buy, sell. Some of you might be confused once it comes to that. But first part, once you can understand, then only we are going to move to the subsequent section. Now, this is the complete definition of it. If I am an option buyer, I will need to pay a premiums. Now, if you compare to your futures, this premium is like your margin, your deposit. So if you want to own a contract, then you need to pay an upfront premium. But in option, we call it as premium because the way it doesn't really react like a deposit or a margin. Because like in futures, if you are paying a deposit or a margin, which we call, it is refundable. Meaning when you close your contract, plus minus your profit and loss, then the remaining will be refunded to you. But for option itself, when you pay a premiums, this premium is not refundable. It's not refundable. They give you the rights, whether you are going to exercise or not, but in terms of premiums, when you pay, it is not refundable. It's like commitment fees. Then as an option seller, you are going to receive the premium. So when we transacted at the initial stage, the difference is here. So buyer pay premiums, seller receive the premiums. The rest you don't need to pay. So seller in a way is when you started, you don't need to pay any upfront. You don't need to pay a deposit, you don't need to pay your premiums, you don't need to pay a margin, etc. Now, but when it comes to exercise the contract, if you are option seller, if your buyer choose to buy or sell the underlying asset, you are obligated to buy or sell the contract. You ignore the buy or sell first. I do not want to confuse you, but you ignore it. Later, I'm going to explain to you. That's why I say option compared to futures, they are more difficult. But once you can understand, the rest is easier for you to digest it. So I repeat, as an option buyer, you pay the premiums, but you have the rights or obligation. You have the rights, but not obligation to buy or sell an underlying asset. But if you're option seller, you're going to receive the premium. Initially, it's better for you, but later stage, if your buyer decided to exercise, you must fulfill your contract itself. One is they have the rights to choose to exercise or not to exercise. But once they choose to exercise as a seller, you must fulfill the contract. Now, until here, you must understand, because this is the first part only. Most important thing, as I mentioned to you, is the premiums and whether it's a right or an obligation. Once you understand this, then only you move forward, because you're going to see that it's even more difficult. So if you cannot understand, try to repeat these few slides before you continue with it. So I repeat, as an option buyer, you need to pay a premiums, but you have the rights. You have the rights to buy or not to buy. In a way, you're not obligated to do so. But as a seller, you're going to receive the premiums. But if the buyer decided to exercise it, you must do so. You must fulfill it. Now, once you understand this, we are going to move to commonly being used terms. Now, what are the commonly being used terms, like terminologies itself? This is the part. That's the reason why when it comes to option type, we have call and put. That's why just now I still remember I told you need to understand holder, which is the buyer, seller, which is the writer. You need to understand the difference. Mainly is in terms of the premiums and also in terms whether you have the rights or obligation. But when it comes to call and put, it's just purely call, meaning you are bullish towards the market. Put, meaning that you are bearish towards the market. I repeat, call meaning that you are bullish towards the market, put meaning that you are bearish towards the market. So you can see that call option meaning that you are going to buy the underlying asset. Put meaning that you are going to sell the underlying asset. But if I'm going to insert this, if you are a holder, you have a buyer of a call option or you are a buyer of put option. So buyer, can you see, is the rights to buy the underlying assets. If you're a buyer of put option, it's the rights as a buyer, whether you want to exercise to sell your underlying asset. That's why you need to separate in between buyer and seller, call and put. If not, you'll find very confusing, because at the end of the day, you notice that, seems like buy, because call is a buy, sell, put. So it will be very confusing. So get these two parts correct. Separate the buy. Remember, if you're a buyer, you have the rights but not obligation. You need to pay your premiums. If you're a seller, you have the obligation to do that, but you're going to receive the premium. Then when it comes to call and put, one is you're bullish towards the market. One, you are bearish towards the market. Then you'll find it very simple. Now, this is what I meant. Before I explain the previous part, if you started with this buy call, you are going to confuse. What is buy call? Why buy? Then sell call, sell, buy. Confusing, right? But if you can understand, the main part is whether you are buyer or seller, is whether you have the rights of obligation. Then call or put is just one is a bullish market, one is a bearish market. So meaning if you are buying a call, meaning that you are expecting the market to move higher. If you are buying a put, meaning that you are expecting the market to drop. As simple as that. And when you open a buy call, eventually you need to sell a call to close your position. If you are going to open a sell call, eventually you need to buy a call to close your position. Similarly, it's like your futures. If today you buy a December contract months, if you trick at that is your call, for example, if you start by selling a December month, you need to buy a December month to close it. You cannot buy other months, then you cannot close your position. Now, this is the part, another definition that you need to understand. This is the actual trading platform. Now, can you see the C here, meaning that this is a call option. Now, the product is FKLI, meaning that your underlying will be FKLI. Later, I'm going to show it to you. So your index futures, this is for option. Then the contract months, which is December. Later, I'm going to explain to you 1,400. What does this mean? But you can see this C, meaning that this is a call option. Now, if you have this P, meaning this is a put option. So we still remember just now the option types, we have two. One is call option, one is put option. Different. Now, this summarizes the whole things, but how do you read this table? Please follow me. We only look at buyer. Don't look at seller first. Once you understand the buyer, the seller part will be easier. And we only focus in terms of the middle part. The rest, I'm going to explain in the later stage. The premium or the potential loss, we can explain in the later stage via the payoff diagram. But in this particular part, we just need to understand the definition. So please look at this part. So buyer, we have two types. Call, you are a buyer of a call option or you are a buyer of a put option. Still remember? Now, if you are a buyer, then you have the rights. Remember? Call meaning you are bullish. You have the rights to buy the underlying asset. If you are a buyer of put option, you have the rights to sell. Easy? Once you understand this, remember seller, they have the obligation. Then here's buyer, here definitely is seller. You can't have both buyer, right? So if you can understand the buyer parts, then you can understand. I repeat, very simple. You separate into buyer and seller. Buyer, then you have call and put option. Call option is you're bullish towards the market. Put option, you're bearish, meaning you're expecting the markets to trade towards downside. So buyer, the main difference is you have the rights but not obligation. Seller, you have the obligation but not the rights. So once you understand this, then only you can continue from now. If you cannot understand, I strongly encourage you to re-listen before you continue. That's why just now, still remember initially when we started, I told you, either you can understand, you understand very well, either you're confused at the initial stage, you're going to confuse yourself. But the most important thing, as I mentioned to you, you just separate between buyer and seller, understand the main difference between a buyer and seller, and the different call and put. This one is towards the market direction itself. Once you understand, another terminology that you need to understand is what we call as this is our strike price, meaning the exercise price. Another terms that we are using, meaning when you want to exercise the contract, we need to specify a price that we are going to exercise. Something like some sort like today, if I'm going to go into an agreement, I'm going to buy from you an iPhone 15, let's say for example. So we need to agree a price. We need to agree a date. We need to agree a price. So this price is what we call as your strike price, the exercise price. Let's say we are going to buy or sell together at 5,000, for example. So that particular price in option we call it as a strike price or exercise price. So meaning this contract we are going to exercise at 1,420. Now, next, this particular price, this 12.4, this is what we call as a premium. Still remember, as a buyer of an option contract, we need to pay an upfront premium. So this upfront premium is what we call it as this 12.4. Because this is FKLI, each point is equivalent to 50 ringgit Malaysia, meaning we need to take this 12.4 times 50 ringgit Malaysia, that is about like 500-600. That is, as a buyer, if you are going to buy, we need to pay a premium of this 500 to 600 ringgit Malaysia to the seller. The seller is going to receive this. This is the only things that initially they are going to transact. So buyer will need to pay a premium to seller. Seller just receive the premium. Now, next, once you understand the number 1, number 2, the most difficult part actually is 1 and 2. 3, 4, 5 is quite similar to your futures. So get your number 1 and number 2 correct. The rest is easier. Then from there, once you are going to move into trading strategies for option and subsequently a combination of trading strategies in between option and also futures, you'll find that it's easy. Clear? So the next part is product available. Now, please refer to the red color box. I believe this is red color, right? The yellow color or orange color, this one is more towards futures. Can you see that? Here is option. So we have CPO option, the underlying CPO futures. That's the reason why previously I told you that you need to have some background or some basic understanding about futures, because in this case it's futures. But if you do not have, because option, the underlying can be stocks, Can be anything, can be forex, can be anything that you name it. So these, in our perception or in this context for this particular topic, we are going to refer to the underlying, which is the futures. So we have CPO option, we have the underlying is CPO futures, and for FBM KLCR option, the underlying is FKLI. So basically, mainly traded is this FKLI option and also CPO option. Although Malaysia right now, you can see that the volume is really very thin, but some of the times you can still exercise or you can still trade it. Now, last two part is the underlying market and contract specification. I'm going to combine these two because you're going to see that in terms of contract specification, you're looking at the underlying market as well. Who is their parents? Still remember just now your FKLI is the underlying for your OKLI. FKLI is the underlying OKLI. Your option, the underlying is your futures market. Now, I'm going to run through this very fast in terms of contract specification because previously, if you understand futures itself, you know that contract specification would define everything about the products itself. So similarly, for OKLI, I just want to highlight a few things. You can see the underlying instrument is FKLI. Future option itself, start with O, you can see, so it's OKLI, underlying is FKLI. Now, in terms of contract months, meaning the months that you can trade, the trading hours, the pricing unit is definitely similar to your FKLI, since the underlying is FKLI. So you can see that similarly, spot month, next to quarterly, then the trading hours, they are the same as per your FKLI. So if you have that particular knowledge, then you'll find that quite similar. That's the reason why I said I'm going to go through only, glance through it. Now, the only difference is the minimum price fluctuation. For FKLI, still remember is 0.5, meaning our index can be 1004.5, then 1001, 1001.5. It can be every time when it moves 0.5. But option, they even have a smaller minimum price fluctuation, is 0.1. So since 1 point is 50 ringgit Malaysia, basic, right? So this one, when it fluctuates by 0.1, is equivalent to 5 ringgit Malaysia. That's why your understanding in futures is important for you to really understand this topic, because since we are in derivative market, we are going to explain from derivative perspective. Now the rest is not important, you can read it by yourself. The last part is the option type is European, meaning the exercise part, we have two styles. One is European style, one is American style. American, you can exercise anytime. European, it must be an expiration itself. So this is European option. Now coming into this payoff diagram, in short, payoff diagram is the terms that we are using in option itself. That's why I do not want to change it. But another way to define this payoff diagram is like your profit and loss. In futures, we call it as profit and loss, but in option, we are so used to call this as payoff diagram, but layman terms is your profit and loss. So basically, we have 4 different types of option. You have long call, long put, short call, short put. Let me do a final summary for you to really separate this. Remember, long meaning you are a buyer. Buyer, the difference is what? You're going to pay premiums and you can choose to exercise or not to exercise. If you're a short seller, you must exercise if the buyer decided to exercise, and you will receive a premium. Still remember? Now, in between call and put is call, you're expecting the market to be bullish. Put meaning that you're expecting the market to be bearish. Once you can understand, then this payoff diagram is easier for you to understand. Now, don't look at the payoff diagram itself. You can read it by yourself, but I'm trying to focus in terms of the wording here. Upside and downside meaning, upside in the way is like your profit, potential profit. Downside meaning your risk. We are looking at the risk part. So in terms of upside, they are unlimited, because you long a call, meaning that if the market moving higher, you have unlimited profit. You can choose to exercise it, then you have unlimited profit. But if the market going towards downside, then your risk is also limited to the premium that you have paid. Your downside for futures is unlimited, am I correct? If you long a futures contract, if the market drop, you have unlimited in a way, provided you cut loss by yourself. But for option, because you have the option to choose to exercise or not to exercise the contract, if the market going against you, then you don't exercise. If you don't exercise, but because initially you already paid the premium, then this is the only risk that you are bearing. This is the main difference. Now, once you can understand long part, then put part, you can understand long buyer side. Seller side is even more easy for you to understand. It's exactly opposite of this. Now, if you're long put meaning you are bearish towards the market. You expect the market to drop. So the same thing, your potential is unlimited. If the market drop, you have unlimited profit because you can exercise the contract. You as a buyer, you have the rights to exercise the contract. So if you can exercise the contract, then your upside, which is your profit part, is unlimited. But the same thing, your risk, downside meaning that your risk in a way is limited to the premium paid. Meaning if the market rebounded, heading towards upside, you can choose not to exercise your contract, but don't forget, initially you already paid the premium, but your downside is limited to this premium. If you can understand this part, this is exactly the other way around. Can you see that? In this case, if you short call, your upside is limited to the premium that you receive. You do not have unlimited profit. Your profit is limited to these premiums that we receive. But the other way around, can you see, is totally opposite. So what you need to do is you try to understand the buyer side. The seller side is exactly opposite of your buyer side. That's it. Clear? Now, the last part that we need to understand is we need to know why we need to go with option trading. Certain circumstances, if combining option and futures will benefit you more. And certain scenarios, option will be a better choice. Now, what are the benefits of option? First, limited risk, definitely, especially if you are a holder or you are a buyer of an option, you can see that even before you commit, you already know that this is your limit, your limited risk. Like just now, the scenario is 12.4. So the 12.4 times 50, right? That is 5 to 600. That is your maximum loss, or what we call as your limited risk, especially as a buyer. Now, second part is leverage. Now, let's say like just now the 12.4, when you are going to buy an option, you pay a premium. This premium is about 5 to 600 only. The leverage is even bigger than your futures. Do you notice that? Futures, if you want to own a futures contract, you need to pay 4,000. Right now, the margin for FKLI is 4,000. So 4,000. But in this case, if you are a long an option, you just need to pay the premium, which is only about 5 to 600. It's about 10 times. So your futures already are leverage products, but option even more. That's why both sides double-edged sword. So we need to look at both sides in future when we look into the what we call trading strategies for option contract itself. Now, the last one is the flexibility. You can see option by itself, the word by itself, meaning that you have a choice. It gives you more flexibility. But futures, if you are going to commit by yourself, you really commit into it. But option, if the market going against you, you have the flexibility whether to exercise or not to exercise it. That's why they give you more flexibility. So I hope that for today's class itself, although a bit lengthy, I hope that you can really understand about this option itself. And through that, in future, we are going to discuss about the trading strategies for option itself, and maybe another topic about a combination of option and futures. Now, if this is your first video, remember to subscribe to our YouTube channels and on your notification bell. And please remember to give us a thumbs up for this particular video. My name is Ty'ng Ty'ng. I'm going to see you in our next video. Bye-bye.